Good day and welcome to today's CBD Sorted session on the audit of disclosures. I'm Edwin Saltz and I'll be taking you through today's session. Please, if you do have any queries, please feel free to submit them via the chat. We'll be watching out for them so that we can respond. There's no live streaming here because of the COVID-19 lockdown, but we will be taking questions. You'll just have to type them and then we'll respond to all. Right, let's then get on with today's session. So, very interesting topic, the audit of disclosures, and we'll also be touching on some new aspects of what's been topical going on around the world. So, let's have a look at the session. So what we're going to be dealing with today is the understanding of assertions, and particularly the assertions around disclosure. What do we need to consider? How are the assertions relevant in the planning side? What assertions do we need to focus on when addressing the audit of disclosures? We'll be touching on the ISA 200 aspect there, what one needs to consider, the focus of an objective of an audit. We'll also be looking at audit risk with a focus on assertions, and particular focus on aspects around the audit of disclosures. What does one need to consider, particular risks. We'll then move over to materiality, very important, particularly the focus when auditing disclosures around what we need to look at, the qualitative versus quantitative materiality. Then we'll be looking at understanding financial statements and the impact that should have on the audit of disclosures. We'll then touch on some general procedures, what you need to look at, some of the overall audit considerations. We'll then have a look at the inspection findings, both locally and from around the world, the common pitfalls that we find are relevant and present from the reviews that have taken place. We'll then focus in on some key areas, related parties, accounting estimates, directors' remuneration, and then looking at subsequent events and going concern, we will touch on the COVID-19 implications that we're presently living through. Hope that's going to keep us busy for the entire morning. If you please have any questions, please do feel free to communicate them as soon as you have any question. Just please type that in the chat, and we'll respond as soon as we see it. Great. Then I think let's get started with the learning. So looking now at understanding the assertions, and we know that since so we've got the assertions, and what's very important is to understand what's the difference from a managed perspective and the auditor's perspective. So when it comes to the assertions are ultimately representations made by management, which are either explicit or otherwise embodied in the financial statements. For example, when management present the financial statements, there's implied by management that everything that should be in the financial statements are included, and very much so that if anything is omitted, it would not influence the users. There's also assertions that then the auditor has a responsibility to test, to gather evidence, to fill that bucket as to whether or not the financial statements fairly present. And those assertions that the auditor carries out work on is there to look and see whether or not what management have said, be it implied or otherwise, the auditor has been able to gain sufficient evidence to support what's there. And particularly remember, when it comes to everything that management say, what management make those statements by way of declarations, by way of inclusions in the financial statements, be they monetary or by way of notes or accounting policies, which ultimately give users a better understanding then of what is included in the financial statements. So let's then have a look at the assertions, and ultimately management, for every single statement that there is included in the financial statements, there is a consideration of what the auditor needs to assess, but more importantly, what management have stated around the different assertions, around anything from the primary sets of financial statements to any information included in the audit, as well as disclosures, accounting policies, any notes, as well as quantitative disclosures, as well as qualitative, because that's ultimately where users will then gain information to understand what it is that management are actually portraying, what the financial position of the entity is. Any examples that you could think about would be welcome. I'll give you a couple of moments to consider that. So, in addition to what's been received, I think it's important to realize that we need to focus on completeness, very important, accuracy, that the amounts that are disclosed in the financial statements are correct, that the value is appropriate, that it's substantiated, can be backed up by the accounting records of the entity. It's therefore important that people have a clear understanding and management present fairly an understanding of the transactions in sufficient detail for users to gain a better appreciation for the performance of the entity. Now, very importantly is to consider the impact, for example, of when it comes to classification, how, if something's included in operating expenses versus cost of sales, how that could have a direct impact on, for example, key measures of the organization, such as the gross profit percentage. And therefore, it's critical that management consider these aspects, and therefore the auditor uses these very same assertions, which correspond to representations of management, to establish whether or not the classes of transactions have been appropriately recorded and presented in the statement of comprehensive income, the accounting policies, and the notes. Please, like I've said, if you have any queries or questions, please do feel free to submit them on the chat line. So let's then have a look now at the account balances, or the statement of financial position. And there we need to focus on the assertions that relate particularly to what is included therein, and that would incorporate the existence that if there is any balances recorded, be that debtors, creditors, inventory, that those amounts, those values do actually exist, the transactions have taken place. With regard to liabilities, there the management are asserting that the entity holds or controls or has rights to assets and liabilities, that the resulting liabilities are the obligations of the entity. With regard to the completeness, all assets, liabilities, equity interests that should have been recorded in the financial records have been recorded together with their related disclosures. The accuracy, valuation, and allocation looks at the classification of assets, liabilities, and equity. We'll have a look at some of the regulators' concerns in that regard a bit later on during the session. And then, very importantly, that the amounts have been included at the appropriate values, reflecting the amounts which assets can be realized, expected to be realized, and liabilities settled in the ordinary course of business. Remember, this would include the consideration of the going concern assumption, the basis for preparation. And then when it comes to classification, one needs to make sure that they are appropriately classified so that there's clear understanding of the nature of the item. And finally, the presentation has been designed to be appropriate under the circumstances. When it comes to the disclosure assertions, primarily we'll be focusing on the classification and presentation. However, obviously, everything that's included in the financial statements has a direct consideration, a direct implication, and something that would need to be measured and considered by the auditor, because management, there's an underlying representation that management is making about any item presented in the financial statements. So, for example, if we had to consider something along the lines of classification, one needs to make sure that, for example, the current, non-current liabilities are appropriately classified under the circumstances, because that would also affect key ratios such as liquidity, which would have an impact on the going concern. Then, with regard to the audit then of the assertions, so an audit is the process whereby procedures are carried out based on risk to obtain audit evidence whether or not the picture being painted by management is a true and fair picture, and that the information can be readily understood. It is important to understand that as auditors, we do not express an opinion on the general ledger, but the financial statements are the auditor's subject matter, which the auditors examine to determine what has been disclosed, what has been presented, the values in terms of all the assertions that we discussed, and whether or not there is sufficient and appropriate evidence to support those amounts that have been presented. So when it comes to the overall objectives of an audit, The key focus is that the financial statements needs to include information that needs to be structured in such a way that the historical effect of the transactions is included in the financial statements, and the entity's accounting system about how those economic events have been reflected in the financial statements, whether or not that is in accordance with the entity's financial reporting framework and takes into account the obligations of management to report at a particular point in time. The disclosures, which is the focus of today's session, comprise those explanatory and descriptive information whereby the management are expressly stating how the entity has performed, and that information needs to be presented to the users of the financial statements in accordance with the financial framework or any legal framework. For example, some entities are regulated, pension funds, retirement funds, the Financial Standard Conduct Authority has specific requirements, and then there's other sometimes legal frameworks. For example, the Attorneys Practices Act, the Legal Practices Act, as to how financial statements need to be prepared for the users that are sometimes like regulators that are specifically relying on those sets of financial statements. Right. We know that the purpose of an audit is based on the engagement partner's opinion whether or not the financial statements present fairly in all material respects, that the statement of financial position and its financial performance and cash flows for the year then ended are fairly presented in accordance with the applicable framework. Could be, for example, full IFRS, and in the South African Companies Act perspective, in accordance with that legislation as well. Very important is that every single amount that is included in the financial statements is a disclosure, and therefore it is the auditor's responsibility to make sure that sufficient evidence is obtained that the amounts, the wording, everything is included in the financial statements and has been verified to the best of the auditor's ability in terms of the auditing standards. So when it comes to audit risk, so we need to focus on audit risk, but from the perspective of auditing the financial statements and particularly around the disclosures. So inherent risk is the susceptibility of an assertion about a class of transaction or balance or disclosure related to one of them, in which there could be a misstatement that could be material, either individually or in aggregate, with other misstatements before the consideration of any related controls. And that's very important because what we're looking at is the intrinsic susceptibility, the possibility that the amount may be misstated. That's before the consideration of controls. Yes, the auditor needs to consider the risk of misstatement around disclosures, and there may be controls that are specifically relating to disclosure to preparation of the financial statements. And therefore, control risk could be considered in the preparation of the financial statements as well. Control risk is the risk that there could be a misstatement in an assertion about a class of transaction or account balance, and how that has been included in one of the primary financial statements, the notes, or the accounting policies, which could be material either individually or in aggregate, with other misstatements, and which may have been prevented or detected by the control on a timely basis as a result of the system of internal control that has been developed by the management of the entity. Detection risk then looks at, based on the objectives, based on the way in which management have designed and implemented their systems of control, whether or not there's sufficient evidence, there's sufficient procedures that have been carried out to determine if the risk of not picking up misstatements, including those relating to disclosures in the financial statements, have been satisfied or not. The source for looking at the inherent and control risk would be failures to detect material misstatements in the financial statements from a control risk perspective. And then from the detection risk, well, that's where the audit procedures are focused to determine whether or not the types of procedures have been appropriate, whether or not the extent of work carried out by the auditor has been adequate to get sufficient appropriate evidence, whether or not there are any misstatements included in the financial statements. Right, I think that's all I wanted to say on this slide. I don't know, please, as I've said, if there's any questions, please feel free to give your views, to ask questions, to clarify any points that you wish to be clarified. It is an example that an example of inherent limitations regarding the nature of financial reporting is because judgment is involved by management, and therefore, as a result thereof, due to their subjective decision making or assessments around what to include and what not to include, there's always a risk that something may or may not be appropriately designed, or may not be appropriately included, or may not be described adequately, and therefore the auditor needs to make sure that they consider these factors as a result of the audit of a set of financial statements, taking into account that management may be looking to present or do something to bring about a particular picture they wish to paint. How that accounting software has been included in the financial statements, incorporated, is that information integrated, how's it summarized, how's it related to the financial statements, are there underlying subsidiary ledgers, how's that information find its way into the general ledger, and then ultimately summarized into the financial statements. Moving on then, the auditor is then required, from this understanding of the entity, its systems, and related business processes, to perform a risk assessment. And that risk assessment needs to look at all transactions and balances and the disclosures relating thereto to determine whether or not the information is subject to a risk of misstatement. When it comes to the Statement of Comprehensive Income, which deals with the transactions, one needs to look at the transactions together with the related disclosures, be that the notes, what's included, the primary sources of revenue, the streams of revenue as it's more commonly described, as well as the accounting policies and whether or not that information has been appropriately described. Very importantly is the accounting policies that relate to the way in which those transactions are recorded. We know we've got a new revenue standard, IFRS 15, which is less than 2 years old, and the auditor needs to make sure that what management have included in those financial statements is appropriate, and that is the way in which the financial statements have been prepared. When it comes to the account balances, well, one needs to gain adequate evidence that those account balances are supported, that they exist, that the value is appropriate, and where the risk, where the chances are that there may be errors, and particularly where disclosures may be lacking as a result of, for example, new accounting standards, or as the next point clarifies, well, what about complex areas, areas where management have applied judgment, areas where experts have been utilized? Those are the areas that one needs to make sure that there is adequate consideration around what management have done and the possibility of misstatement. It's therefore very important from a risk assessment point of view that the financial statements are received as soon as possible in the audit process so that these risks can be given sufficient time to be considered and focused on where in the financial statements there is a higher risk than others, because that would affect then the nature, timing, and extent of testing that the auditor would need to carry out. Right, so when it comes to materiality, so we know that overall materiality is the measure by which the auditor, based on their professional judgment, determines whether or not the financial statements are materially misstated or are fairly presented. And therefore materiality is the significant, very significant in terms of the financial statement information, because that is ultimately what would be utilized by those making economic decisions relating to the financial statements. And what's important to realize is that when it comes to the determination of materiality for the purpose of the audit, the auditor uses something called performance materiality, which, as a result of sampling, as a result of the inherent risks in an audit, there's a risk that information may or may not be detected. But when it comes to overall materiality, that's not based on audit risk, and there the auditor needs to put their selves in the perspective of users of the financial statements, and the determination of overall materiality, while it is a aspect of professional judgment, it looks at it from the purposes of the users of the financial statements and is not based on the risks inherent in an audit, and therefore one needs to look at the context of the financial reporting framework, the complexity, the different users, the knowledge of management, and to whom they delegate the preparation of the financial statements, to understand the risk of overall materiality as to how there could be a possible misstatement included therein. So the key then is looking at the users of the financial statements, and particularly the needs of those users as to for what purposes the financial statements are used, and therefore key in the auditor's consideration is the impact of qualitative factors that could influence the users of the financial statements. For example, we know when it comes to financial reporting, there's numerous new financial reporting standards that have been introduced, IFRS 15, IFRS 9, both of which are very new, and then IFRS 16, the new leasing standard, also being introduced and implemented for some audits currently underway. And therefore, these new reporting standards may require additional qualitative disclosures, may require changes to accounting systems, which process and summarize the financial transactions. There may also be, for example, changes in the entity, for example, by way of economic circumstances that may affect liquidity, may affect its customer base around the disclosures. There may also be negotiations around discussions with financiers around debt covenants, making sure that liquidity terms and conditions in terms of agreements are adhered to, and particularly where an entity may find itself in financial distress. And therefore, all of these events or circumstances that led to recognition of impairment losses in the past would also need to be considered, whether or not the circumstances are still appropriate under the circumstances, if there's been any changes, and is this likely to impact the users of the financial statements. So moving on, we then need to understand from the perspective of the materiality. So materiality applies equally to information presented or disclosed in the financial statements, in the primary sets of financial statements, but very important then is how that information is explained so users can gain a better understanding of the specific circumstances, the specific transactions, the specific way in which management have applied standards to the entity that is reporting their transactions. That would include the development of appropriate accounting policies. For example, IFRS 9. Is the entity utilizing the simplified or general approach to arrive at the expected credit losses? Has it taken into sufficient consideration what the transactions are, how those transactions would influence and give rise to different risks in the different possible groups of financial instruments, perhaps in terms of different sectors of the market, or just in terms of geographical dispersion of its customers. Materiality then needs to be considered from the financial reporting framework and considered as to what to apply. if something is not material, then that information does not need to be disclosed. Very importantly, from the perspective of management as to what accounting policies, what disclosures to include. The Accounting Standards Board is looking at a decluttering of the financial statements, and therefore the auditor needs to look at materiality and understand whether or not omissions, errors or misstatements or inclusions in the financial statements are warranted, because this is information relevant to users of the financial statements. We need to also focus on the sources of information that users have and that is available to the auditor. And that remember that users of the financial statements don't have the detailed information that is summarized and collated by management, which records all transactions, being the general ledger, which then forms the basis upon which to include information, extract certain information in the to the financial statements, which is then appropriately presented. Also, very importantly, there is consideration around management prepared reports. This could be information prepared for management discussions and meetings, as well as considerations around information used by experts, actuarial reports, impairment calculations, goodwill considerations, valuations. All of this information is information which management utilize and then need to filter to determine what then can be included in the financial statements that is relevant to the users. And therefore, from an ISA perspective, the auditor needs to examine that information. They need to make sure that that information is sufficiently reliable, that they're able to obtain evidence of the accuracy of the amounts and disclosures that are presented, as well as the completeness of that information, because management may be looking to paint a particular story around the entity by either omitting or including certain information. And therefore, the auditor needs to carry out procedures to ensure that what is disclosed is sufficiently precise and in sufficient detail so that users have a clear understanding of the information and the source from where it is, and it can be interpreted as if the full details from where that information is coming has been appropriately summarized and analyzed and presented by management, so it's not distorting the true nature of the financial position or performance of the entity. When it comes to the risk of disclosures, we know there's an overriding risk of fraud, and management need to try and make sure that they do not obscure information, and it's the auditor's responsibility to ensure that they gain evidence that they have considered the risk of management manipulating information, manipulating disclosures, including disclosures that are not clearly understandable, and therefore the auditor needs to take that into account from the onset in terms of at the beginning of the audit, to establish where possible misstatements could be present, and therefore as a result thereof the auditor needs to design sufficient procedures to respond to the entity's susceptibility of the financial statements to the misstatement of fraud or error, and particularly around the disclosures, the amounts as well as the narrative around those amounts as to how the entity has performed as a result of transactions and agreements that it has entered into, and whether or not there is a misrepresentation of that information, because that's something from a professional skepticism point of view the auditor needs to remain alert for continually throughout the audit. We know that the financial statements are prepared based on an applicable financial reporting framework. The two primary financial reporting frameworks in South Africa are IFRS and IFRS for SMEs. IFRS, as we've mentioned, has had numerous significant new accounting standards that have put in place. IFRS for SMEs are a bit more of a stable framework in terms of change, but new amendments to the IFRS for SME reporting framework expected within the next year or two. So we need to make sure that management are aware of what those disclosure requirements are, and that the auditor designs sufficient and appropriate procedures to verify whether or not the financial statements have been prepared in all material circumstances with the requirements of the applicable framework. Remember, there are general disclosure requirements, and then certain standards also have specific disclosure requirements. For example, IAS 36, the impairment standard, looking at impairments, looking at reconciliations for the impairments between the movements in the account. Those are specific requirements that need to find their way into the notes of the financial statements. When it comes to the primary sets of financial statements, so the auditor needs to make sure that there's a sufficient understanding of all the elements included in those primary sets of financial statements, starting with the statement of financial position. There's different standards, IFRS 9 dealing with financial instruments, which find their way into loans, receivable, different classifications, classifications from an equity versus liability perspective, looking at the different current versus non-current assets, and the different measurement models that are applicable to inventories versus trade and other receivables versus PPE. And these need to be properly understood, properly described, and then appropriately recognized and measured by management, and then disclosed and audited by the auditor. With regard to the statement of financial performance, or profit or loss and other comprehensive income, there are different requirements in terms of how that can be summarized together with the statement of changes in equity if IFRS for SMEs is being presented, subject to very minimal information being included therein. That needs to be appropriately considered, as well as the components and the classification, as well as other reporting measures that may be utilized by entities, and particularly disclosures for listed companies that would lead them to a better understanding of the financial performance and headline earnings per share in a JSE context. The appropriate classification of changes in equity, the different types of reserves, for what those reserves are utilized, why have they been set up, and then the statement of cash flows. The statement of changes in equity and statement of cash flows are two areas which we'll discuss in a bit more detail, where the regulator has identified that there is significant lack of audit evidence, lack of adequate procedures to substantiate the information that's being included. And then with regards to the notes, so the notes, we've spoken about reconciliations. When it comes to specific standards, there's additional disclosure requirements. For example, areas around impairments of goodwill, looking at valuations, whether experts have been used, and then there's sometimes information that's included in the notes that's not even directly relevant to specific items on the primary financial statements. Those are areas around liquidity, areas around fair value measurements, the fair value hierarchy that may cover quite a big scope of different statements, different assets in the statement of financial position. And then credit risk, those liquidity risks, all those risk management disclosures as required in terms of IFRS, and then significant judgments and key sources of estimation uncertainty required by both the frameworks utilized in South Africa. And the auditor needs to not take the financial statements and look and see whether or not the financial statements is correct and agrees to the working papers, but the procedure should actually, and there should be working papers the other way around, that for every account balance transaction that the auditor looks for the assertions, tests those assertions, does more work on the assertions where there's a higher risk of material misstatement, and then at the same time, in terms of the assertions, the way in which they've been classified, looks at the disclosures relevant to those amounts finding their way into the financial statements to ensure that they are appropriately described. In terms then of the applicable framework, so the auditor needs to make sure that they have a deeper understanding of the types of assets, the types of liabilities, the classification thereof, the types of revenue streams, the different sources of revenue, the way in which management have applied new standards to make sure that the entity is appropriately recording the transactions and dealing with them and presenting them in a way that is useful to the users of the financial statements. In terms of understanding those disclosures, well, yes, there's no one procedure that fits all disclosures or notes, and therefore the audit of disclosures of the financial statements is specific to each entity. It needs to be tailored to the applicable financial reporting framework and focus on the qualitative disclosures, for example, the risk management disclosures, as well as the materiality of the entity. Some examples: the completeness of inventory, a procedure that's generic to all entities, but a stock take, as we know, is not a simple procedure, and there needs to be appropriate samples drawn to satisfy existence as well as completeness, and by the very same manner, the way in which it's then ultimately summarized and then presented in the financial statements must give an understanding of what information was presented, and the auditor needs to verify the different aspects of inventory, the different subcategories, as well as the accounting for that, the subsequent measurement being that at the lower of cost or net realizable value, and whether or not there have been any stock impairments. If there had been, that's a disclosable item which would need to be not only disclosed and presented in the financial statements, but also evidence obtained by the auditor to verify that the amount of the impairments, etc., has been appropriately disclosed. In terms of the general procedures, well, when a set of financial statements is received, it's important that the accuracy of that set of financial statements is appropriately looked at. In the past, it was common for somebody to manually cast and cross-cast the financial statements. Now, often the auditor uses those financial statements in an electronic package where it interrogates the information, and therefore they would need to make sure that the mathematical accuracy of the financial statements is also recorded, even with the use of technology and software utilized to prepare financial statements. Depending on how that software is utilized, sometimes there could be bugs in there. Sometimes there's a lack of understanding to appropriately use that software to present financial statements appropriately, and therefore one needs to make sure that the information is adequately understood, and the reporting frameworks as well as the reporting packages are properly understood, because there are risks that mathematical inaccuracies can be included. With regard to the primary financial statements, there needs to be adequate consideration that the working papers agree, and evidence thereof that they have been agreed, from the lead sheets to the financial statements, as well as from the lead sheets to the underlying working papers, because the risk is that either information hasn't been complete, and the regulators actually picked up numerous instances where something as simple as this hasn't been done, which leads to a concern that the disclosures then haven't adequately had procedures that have been carried out. We know that a common way of verifying the disclosures is by use of a disclosure checklist. Now, disclosure checklists are a tool that could be used, but one needs to make sure that the completeness of the checklist and that the financial statements are used and verified to a checklist to make sure that they are in itself complete. And very importantly, similar to disclosure checklists, there may be template statements, template information that is utilized for the preparation of financial statements, but care must be taken to ensure that these are not generic and that they are tailored to the specific circumstances of the entity, so that a clear understanding of how the entity is applied particular accounting standards, particular choices within accounting standards, or any assumptions and what they have considered in the preparation of the financial statements is clearly disclosed, be that from the use of experts or in terms of different choices from the perspective of accounting policies available, for example, for the measurement of inventory. We'll now look at common pitfalls that have occurred in auditing procedures around financial statements, and with a focus on those that contribute to disclosures in the financial statements, areas where there have been Sometimes the mention of the accounting framework itself has not been clear as to what's been applied by the entity, discrepancies between the audit report, the basis of preparation of the financial statements, or other aspects, sometimes the utilization of accounting policies, which are not in terms of a particular accounting framework. An example that comes to mind is capitalization of borrowing costs in a entity that reports under IFRS for SMEs. That's something contrary to that framework's requirements. And we'll now go and have a look in a bit more detail at some of the pitfalls that have been established and reported by the regulator, and how those being aware of those pitfalls will hopefully lead to a situation in which these challenges can be avoided. Right, so let's understand then the application of new standards and the pitfalls. So the first is that we've seen that there's a lot of generic wording in the standard new application. And also very important with regards to new standards, also looking at new standards that may be applicable to an entity as a result of changes in its environment. So with regards to new standards, one needs to change the generic wording of likely to have a material impact or not likely to have a material impact to an actual assessment that management is required to do to determine what the likely impact is of applying a possible new standard. And the auditor's response then is that, well, they need to evaluate the procedures that management have conducted, whether or not they've been appropriate under the circumstances, to determine whether or not the impact of applying a new standard is likely to be fairly stated. There needs to be a supporting analysis of the impact, how management have considered it. Particularly we've now got entities that will be reporting under IFRS 16 for the first time, and their significant changes as a result of the capitalization of all obligations now being commitments and being now having to be reflected on the financial statements. The auditor therefore needs to get sufficient appropriate audit evidence that management has provided quality and entity-specific qualitative and quantitative information about the application of new standards in accordance with IFRS. And if management has disclosed that there is no impact, no likely impact on the adoption of a new standard, for example, IFRS 16, well, then the auditor needs to corroborate that information based on evidence that management can provide, which substantiates how they have then applied their minds to arrive at the representation that there is unlikely to be an impact on the financial statements. Other pitfalls that practitioners must be alert for is the use of just generic wording and just checklists to establish whether or not information has been included or not. The JSE's evaluation reflects numerous standard wording utilized in the preparation of financial statements, and then also concern around GRAP and whether or not this is still appropriate in the public sector. If you're auditing in that environment, please just make sure that the entity is allowed to utilize those standards. And remember, obviously, SA GAAP, that's a standard that has been phased out. There's also a requirement to make sure that from the perspective of general deficiencies, that one makes sure that presentation and disclosure requirements in the standards are used not as a checklist, but rather to gain an understanding whether or not the entity has such transactions, and if it does, are those transactions material enough to be included separately in the financial statements with the appropriate disclosure. That's something coming from the Accounting Standards Board in the public sector. And there's also a need to make sure that with regards to repetition and declutter of the financial statements, that immaterial or irrelevant accounting policies are removed from the financial statements. There's often extensive disclosure around financial instruments, speaking about hedging, speaking about different categories of financial instruments, which sometimes are not even relevant to the entity which is reporting such accounting disclosures. And rather than repeat accounting policies, it's important for management to disclose in the financial statements how the accounting policies were applied, particularly where there are different choices available in the standard, which choices have been elected by management and the reasons for those elections, and where there is any professional judgment, how that has been included and applied, and considerations and factors taken into account by management to record the transactions become very useful information. With regard to then other deficiencies in the inspections reports, a lack of any procedures carried out in relation to the disclosures around account balances or transactions. It's very well speaking about amounts which appear in the statements of financial position or comprehensive income, but items such as the statement of changes in equity, consideration there, very important, around reserves, if there are any, the nature of those reserves, what those reserves can be utilized for. Such information becomes critical. And then also making sure that when it comes to information for which there is no reference in the primary components of financial statements, for example, the IFRS 13 fair value hierarchy, the disclosure of the different classes of financial instruments, and the risk management procedures, as well as if the entity is operating in the listed environment. There may be a need for HEPS disclosures or disclosures dealing with operating segments, segmental reporting. Those aspects should fully have been audited, and working papers should be the source for verifying the information that's disclosed in the financial statements, rather than the financial statements being a check to see whether or not it makes sense. So a lot more work required in that regard. And then lastly, just to stress again the concept of the need for evidence of the primary financial statements and notes, agreeing to lead schedules, and where relevant to subsequent working papers for reconciliations, etc., where more detail is required in terms of the standards from a disclosure perspective. For example, the PPE recon, that's not something that would be established from the that would need to be established from the working papers, not available from the lead sheet itself. In terms of getting back to some of the auditing principles and challenges around disclosure, so the biggest concern from regulators has been the current versus non-current classification in the statement of financial position. There, because of the impact that would have on liquidity ratios, particularly assets and liabilities. The liabilities itself, remember, a liability, for example, long-term liability versus a current liability, the terms of common related party transactions, unsecured interest-free with no fixed terms of repayment, that often means that then the entities have the ability, either entity has the ability to decide when they're going to repay that. And remember, to defer something as a non-current liability, the entity must have an unconditional right to defer payment beyond the current operating cycle, normally 12 months. The other key focus of regulators to make sure that there is consideration for equity versus liabilities. There, the key that the entity has considered the classification that there is where you've got convertible instruments, shareholder loans, where there may be deferred payment terms. If the entity is looking to reclassify these, it needs to make sure that it meets with the requirements that there is adequate evidence, some sort of technical opinion, which would need to be audited by the auditor to see whether or not there is appropriate support for the classification made by management. Where there are restatements, it needs to, the auditing standards are very clear in that regard, that restatements need to be clearly identified as a correction of an error, and the reason for the restatement needs to be clearly given so that there is a proper understanding of what led to the restatement. Very important that the auditor has sufficient working papers to show how these classifications, as well as between current, non-current, and equity versus liability, have been considered, particularly where there is a high degree of judgment that's required by management and the auditor. With regards to restatements and the adoption of new accounting policies, care must be taken if one's reporting under the full IFRS reporting framework, that there's due consideration for the necessary disclosure around third balance sheets where required. And then concern expressed that insufficient IFRS 7 disclosures. We know around the liquidity, around the classification, the full exposure, the maturity schedules for liabilities, as well as anything else that management deem appropriate. The auditor needs to make sure that if there are any disclosures, that they make sense and that they lead to a better understanding of the financial statements without causing confusion. We've spoken about the IFRS 13 fair value hierarchy classifications. But what's key from the regulators, there must be consideration as to how management have measured those. more than just the disclosure of the amounts in the different categories, what management has considered and how the different amounts have been included in the different categories, the different buckets. And then a key concern with IAS 36, the impairment accounting standard, making sure that there is adequate consideration of, if there is an expert involved, the necessary disclosure of the expert, their expertise, and then the assumptions that have been incorporated and whether the audit evidence needs to be on file to support whether or not those assumptions are adequate under the circumstances. With regard to the IAS 36, making sure that if there are just general impairments, an understanding of how those impairments are calculated, to make sure that there is audit evidence and working papers supporting the amounts disclosed in the financial statements. The next key focus, where there have been significant concerns expressed by the regulator, is in relation to related parties. And for the purposes of this section, we're going to be focusing on the disclosure of related parties, not the audit procedures as described in ISA 540, the entire auditing standard. It's assumed for the purpose of this session that all related party relationships and transactions were identified. Remember, the auditor is required to carry out procedures around the completeness of related party disclosures, and numerous regulators around the world and in South Africa have identified that often there is information in the working papers that sometimes indicates the evidence of a related party, or the financial statements, for example, based on the terms of a loan, that this is indicative of a potential related party being present. And also very importantly is that the auditor does conduct procedures to ensure that all related parties are identified and appropriately disclosed. For example, looking at bank confirmations, subordination agreements, suretyships, legal correspondence. All of these sort of aspects are indicative of possible related parties that have not been presented. With regard to the need to disclose information around related parties, so the most critical aspect of auditing related party disclosure is that it needs to be in accordance with the applicable financial reporting framework. And that then means that irrespective of the presence of transactions or balances, a list of related parties needs to be incorporated. And then, if there are transactions or balances, the value of those transactions or account balances needs to be appropriately disclosed in the financial statements and appropriately audited before it gets to the financial statements. Another key concern is whether or not the transactions are at arm's length, and we'll discuss that in due course. And remember that from a IFRS and IFRS for SME perspective, related parties are qualitatively material, and therefore information in regard to them becomes critical to the financial statements. Looking at arm's length considerations in more detail, there one must have a statement in the financial statements only if it can be substantiated that the transactions are at arm's length. So if no assertion is made that transactions with related parties are at arm's length, well then management have not made a representation, and on that basis then no audit procedures would be required with regard to whether or not that they are not at arm's length. However, if a statement is made that's looking at this here, that there is disclosure in the financial statements that the transactions are at arm's length, well, then the auditor needs to assess what support management have, how they made the decision, what evidence there is that such transactions were conducted at arm's length, and the auditor is then required to carry out procedures to establish whether or not, based on their opinion, the information, the representation of such a statement in the financial statements is appropriate. Examples would be described over here. What are the underlying terms? If the underlying terms are that the loans are interest-free, no fixed terms of repayment, clearly that is not at arm's length. Sometimes it's easier to see. There may be standard prices that the entity engages with its clients, general clients, and if the entity transacts it on the same basis, well, then that's readily available. But most of the time, one needs to just look at this a bit more carefully to establish whether or not in the assertion that transactions are at arm's length can be evidenced in terms of management's evaluation to support such an assertion. An arm's length assertion should be looked at whether the identified related party relationships and transactions have been appropriately disclosed in accordance with the financial reporting framework, and whether the effects of the related party relationships and transactions, are there controls in place that prevent the financial statements from excluding or omitting such disclosures? And then, very importantly, whether the effect of the related party relationships and transactions is appropriately disclosed, the consideration of the omission of such information, whether or not it could be considered misleading from the financial statements understanding. I'm aware of a situation where the majority of the transactions of the entity were with related parties in the group, but this was clearly missing from the disclosure in the notes, to the extent that one failed to realize the impact of the group and the possible ability within which the transactions could have been manipulated. And such an entity is now in liquidation because management had manipulated the transactions between the related parties. The next aspect I wish to focus on is the area of procedures substantively to verify estimation uncertainty. And when it comes to estimation uncertainty, remember, this is a requirement for both IFRS and IFRS for SMEs, significant judgments and key sources of estimation uncertainty. the auditor needs to first of all consider how management has considered alternative assumptions, outcomes, and why it's rejected those in favor of the estimates that it has chosen, and whether the significant assumptions used by management are appropriate, or if they're utilized by an expert, are they appropriate under the circumstances? We can speak about growth rates, discount rates, if one's looking at valuations, is that supported by contracts? In terms of the terms, the forecast period, on what basis is that substantiated? And then, very importantly, even more so than with estimates, where it comes to estimates and projections around going concern, if management are purporting a certain assumption, well, do they have the intent to carry that out? And do they have the ability, the financial resources, the client base, etc., to be able to put the intended plan into place so that the estimation can be achieved in the future? With regards to directors' remuneration, so there's a specific Companies Act requirement that the amount needs to be disclosed. From the perspective of the Companies Act, in terms of Section 30, subsections 4 and 5, where an entity is subject to an audit, the directors' emoluments needs to be disclosed, and it's been clarified that that disclosure needs to be individually per director. Very important that the users of the financial statements can understand the split of those directors' emoluments, and then a breakdown of that remuneration also needs to be included, for example, by salaries, bonuses, travel allowances, pension funds, share options, etc. And finally, the Companies Act has specific requirements that the remuneration paid, if you have a director of an entity, needs to include all earnings that that director has received from other group companies. So if you've got company A with a director, Mr. X, well, any amounts that Mr. X has received from any entities in the group needs to be disclosed in all the companies where Mr. X is a director. I hope that's clear. Looking at then the annual financial statements. So the Companies Act has a specific requirement which differs slightly from the financial reporting frameworks as to what is included in the annual financial statements. And the Companies Act in Section 30 says that if the entity is subject to an audit, the audit report is part of the financial statements. And therefore, it's very important that the requirements of the Companies Act are considered, because one of those requirements are that on the front page of the financial statements is whether or not the entity is subject to an audit or review. That needs to be disclosed. And then obviously the auditor's report would need to be included and would need to be appropriately worded and have sufficient support based on the working papers. In terms of the director's report, so the Companies Act also says that where an entity is part of a group, that there's certain information that needs to be included as well, and where there are directors, the directors should discuss the state of affairs of the entity and or the group, the business in which the entity is involved and any changes to that, the profit or loss that the entity has made, as well as any matters which the directors consider material to the shareholders and to appreciate the state of the affairs of the company, as well as any prescribed information. Note that including a statement in the director's report setting out that the auditor's contention as to the circumstances that resulted in the removal of the auditor, where the auditor so requires, is insufficient, because remember, from the Companies Act perspective, and if the auditor has been removed, the auditor is entitled to clarify the reasons for that removal. Where applicable, the inclusion of an audit committee report and how the audit committee has considered the appointment of the auditor and the scope of services that have been allocated to the auditor. And then, if applicable, a company secretary report would also need to be included. And remember, from the perspective of the Companies Act, this is included in the financial statements, and therefore ISA 720 must then also be looked at to make sure that if there are any disclosures included in the financial statements, that the auditor considers this and considers whether or not any disclosures in the director's report, audit committee report, or company secretary report do not contradict any information in the financial statements, that also being a duty of the auditor in regard to such an extended definition of the annual financial statements. From the perspective of the frameworks, remember there, the framework include the primary financial statements, the statement of financial position, statement of comprehensive income, statement of changes in equity, statement of cash flows, accounting policies, and then related notes. So and they're very important that the no distinction there between IFRS and IFRS for SMEs, but this being an added aspect to it. And then remember, from a disclosure perspective, because a entity's primary financial statements from a framework's perspective is the consolidated financial statements, if it needs to prepare consolidated financial statements. So then the entity would need to make sure, and the auditor needs to consider whether or not consolidated financial statements are prepared, because if separate financial statements are prepared before the consolidated, then this may give rise to non-compliance with the reporting frameworks, and could lead to a audit qualification even on the separate financial statements where there's no consolidated financial statements, as well as from the perspective of implications around reportable irregularities that would need to be considered under the circumstances. It should be remembered that the statement of cash flows is also one of the primary financial statements, and therefore the extent of evidence is the same for any items included in the statement of financial position or statement of comprehensive income, and therefore all the assertions we spoke about previously relate equally to the statement of cash flows. We see that there is significant concerns around deficiencies in the statement of cash flows. The first is the classification between non-cash flow items and cash flow For example, an entity that enters into an operating lease. Well, those normally are cash flows. But an entity that enters into a finance lease, well, the acquisition of a new asset, which is then capitalized, and the corresponding liability that's reflected is a non-cash flow item, and therefore those transactions should be removed. Dividends declared, but only half of which are paid out in cash. The other half settled by way of a loan account to the shareholder. Well, those items are also non-cash items. Other examples is transactions that take place by way of journal entries, related party interest. Even though the interest is a liability and meets the definition thereof from a statement of financial position, it does not meet the definition of a cash flow that has taken place, and therefore interest incurred by way of an adjustment to a loan account would also be a non-cash flow item. When it comes to offsetting of assets and liabilities very rarely takes place, but offsetting of cash flows often does. If an entity has had transactions with loan accounts whereby there have been physical cash advances and there have been payments that have been made, well, it's incorrect to show the net position. The inflows as well as the outflows of cash should be shown at the gross amount. And numerous other examples have also been identified. So please make sure that you look on the lookout for these non-cash items, particularly in related party transactions, and where the entries take place by way of loan accounts. Another key focus and lack of audit evidence is the verification of cash collected from customers as well as cash paid to employees and suppliers if the entity is doing the direct method. And then, no matter what method's being applied, making sure that the cash flow classification is appropriate between operating, investing, and financing. For example, interest payments, have they been appropriately classified? Investment income, is that investing or operating? Should that be split? These are the primary areas of concern that have been identified by regulators for the audit of the statement of cash flows. With regard then to the statement of financial position and the overall financial statement assertion that management represent that of the entity being a going concern. So the principal requirement is that the entity will be considered to be a going concern if it can continue to operate for a period of 12 months subsequent to the financial reporting period. Now, there may be situations or events that cause doubt on that ability, and therefore it is management's responsibility to disclose that information adequately and for the auditor to consider whether or not that disclosure is appropriate, whether or not every everything that should have been disclosed has been included, or if there still exist any circumstances that may cause doubt on the entity's ability to continue as a going concern. And therefore, the auditor needs to evaluate the disclosure in terms of the applicable framework as to whether or not the entity is indeed a going concern. And most importantly, if the disclosures are inadequate, then the auditor is required to consider the impact thereof on the audit report. An example of such disclosure in a going concern note would be one listed on the screen now. Before we go through that detail, it's important to realize that the disclosure needs to be made in the financial statements to comply with the financial reporting framework. Therefore, if information is disclosed in the director's report, well, then the financial statements themselves would still be lacking relevant information, and such disclosure would be inadequate. With regard to the common disclosure that one would see, here's an example of one. The financial statements have been prepared on a going concern basis, which assumes that the company will be able to realize its assets and discharge its liabilities in the normal course of business for the foreseeable future. The company incurred losses of 1.2 million and has accumulated losses at the end of the reporting period of 2.8 or 2.9 million. Management believes that as a result of these losses, there is doubt as to the entity's ability to continue as a going concern within the next 12 months. They then go on to describe what the circumstances are that give rise to the doubt, and that is that the entity needs to return to profitable operations, which would generate positive cash flows, as well as securing additional financing. Management intends to finance operating costs over the next 12 months from working capital, loans from directors, as well as securing additional finance from banking. And the company's ability to obtain this new financing is not known at the time. So that's quite a mouthful. So let's just then understand what then procedures need to be carried out. The first would be as well, the entity has been, the financial statements have been prepared on a going concern basis. Is there evidence, is the auditor satisfied that the entity is a going concern? Have management been able to prove to the auditor that subject to what's mentioned below, the entity will be able to continue as a going concern? And linked to that is, well, what is the profits in the future? Do the budgets take into account realistic expectations, growth rates? Has the adequate financing been incorporated at the necessary time periods? Is that realistic in terms of how far negotiations are with the finances? Do the directors, have appropriate funds to sustain the entity until they secure the banking finance? And then is there evidence of the return to profitability? Can that has that taken into account expected changes in terms of operating costs over the next 12 months? Are they realistic? Does the entity have any cash on hand that it can utilize? And is that likely to be sufficient based on cash flow projections going forward? And then an understanding then of how far those negotiations are with the bank is, the likelihood of success. Has the entity reached its limits? Has the bank, for example, turned down previous funding? So all of this information would need to be considered and then disclosed in the financial statements. Examples of those audit legends: the accounting policy is being prepared on a going concern basis. Is that appropriate? Does the note in the financial statements describe that? Has the amounts of losses been agreed, as well as the statement of accumulated losses? Is that correct per the financial statements? Do the financial statements explicitly disclose a material uncertainty? Because there's specific requirements in ISA 570 that address this because of the implication of that on the financial statements. Have management disclosed their plans adequately? What are they going to do to return to profitability? It's all very well making a statement, but how do they plan to return to profitability? And is that consistent with the evidence obtained and evaluation performed in terms of working paper wherever the auditor has documented the procedures that they have carried out? With regard to the audit report, so there's a very useful flowchart in SARPS 3 that deals with the considerations and impact of an audit report on with the effect of going concern and material uncertainties, and whether or not adequate information is being given and disclosed, and whether or not the going concern assumption is still appropriate. So, the auditor needs to make sure that there is adequate disclosure of the material uncertainty in the financial statements, and if they believe that that is appropriate and that the information is sufficiently detailed to understand how management are going to address the uncertainty, how far negotiations are, that there's no evidence that it's unlikely that, for example, the banking facilities will not be granted. If that information is all present, then if the disclosure is adequate, then there would be a material uncertainty paragraph included in the audit report, referring the information to note 4 in the financial statements, which clearly sets out what information is uncertain and what's that subject to. Very importantly, if, however, disclosure about the uncertainty is inadequate, or the assumptions that have been taken into account do not make sense, and therefore the auditor is uncertain about the entity's ability to trade out of the material uncertainty, well then, even though there may be disclosure around that, then a audit report qualification would be more applicable under the circumstances. We've been living in interesting times, and it's also important when one looks at disclosure to look at the impact of the coronavirus and the impact that that has on subsequent events. From an accounting perspective, one would need to establish whether or not the subsequent event is adjusting or non-adjusting. Remember, if it's adjusting information that was available at the year end, that would have a direct impact and would need financial statements would need to be adjusted, be that by amounts or disclosures, depending on the circumstances. And very importantly, in South Africa, on the 15th of March, the President declared COVID-19 a national disaster, and the RBA issued a newsletter earlier this month, whereby they looked to address some of the implications that this could have on the audits of entities around, for example, disclosure of subsequent events and other matters that the auditor would need to consider around financial reporting frameworks, around subsequent events, IAS 10, and very importantly, the year end of an entity could also have an impact because the announcement was made in March. Well, therefore, an entity with a 31 March 2020 year end would have a adjusting event. This is known information, whereas the result of the announcement in March for a 29 February year-end entity, well, such a matter would be a possibly non-adjusting event, subject to considerations around realization, budgets, going concern analysis, because that would have to be 12 months post year end, and if the audit report hasn't been signed yet, well, the announcement of the shutdown, national shutdown, has already taken place. So therefore, there would need to be adequate financial statement, relevant qualitative as well as quantitative disclosures of how this would impact the entity. I know, for example, the hotel chains, depending on where they're operating, I know there's a group in South Africa that have closed 95% of their hotels for the next month and a half, pending what's going on. They're also looking at evaluating when the shutdown is likely to be lifted and considering when, depending on bookings and that, it makes economic sense for them to reopen. So that would have significant impact. Other implications of the COVID-19 is the emphasis of matter paragraphs, if adequate disclosures included in the financial statements, or if it's not, then a possible qualification as a result of going concern or an impact on the financial assets included in the statement of financial position, particularly the financial instruments. And sometimes if it is, there may be for entities with financial year ends 29 February, well, you may have significant changes in value of investments or projected cash flows, which may need to be disclosed in the financial statements. Important for those of you that are signing off audit reports in the next couple of months to please look at IRBA's dedicated COVID-19 webpage, where this information, as well as other considerations of the impact of this of these new challenges that we're facing, have been described. Other considerations, the impact of COVID-19 on a travel agency. For example, if it was a Feb 19 year end, well, just because the announcement here only happened in March, well, there were countries around the world that were already locking down their borders. So depending on the exposure to local and international bookings, well, that would have a direct impact on a February year end, because some of those effects and considerations were already in place. You know, if, however, the entity is primarily local, well, then possibly those would be non-adjusting subsequent events, which would need to be included by way of disclosure. But once that has taken place, you know, there may need to be consideration of going concern implications. You know, what's happening to cancellation? Is the travel agency liable for that? Do they have adequate cover, or is this purely at the risk of its customers? And if it's not at the risk of the customers, what happens if, you know, instructions were received from a client, the funds were never received, now the client can't travel, and therefore, you know, potentially may raise concerns around the recoverability of trade and other receivables. Another consideration is, you know, concern around certain airlines. Certain airlines internationally have expressed concern that they are potentially facing bankruptcy. Does the travel agent have any specific exposure or risk to such as a result of such media information? Another consideration would be to look at the health information technologies. You know, is this an entity that supports and has infrastructure to entities that are operating during the lockdown? Or is this an entity that, as a result of the lockdown, is also prejudiced, that now it can't implement new technologies that it was looking to because, you know, the health industries are focusing on emergency services only, what's critical to the economy. You know, for example, dentists, they haven't been operating their surgeries other than for emergency cases. So, you know, a lot of information to be gained, a lot of understanding and discussion to be held with management to establish whether or not there is sufficient and adequate disclosure in the financial statements for the effect of entities as a result of their direct exposure to COVID-19. With regard to an overall review of the financial statements, so key concerns there is that often the auditor looks at the detail but doesn't have a look at the bigger picture to see whether or not there is a understanding that the financial statements make sense in terms of the bigger picture, in terms of the industry. The auditor is required to obtain evidence relevant to management's response for evaluating and taking into account whether or not they have adequately addressed their responses to the environment or any other matters that could give rise to a risk that the financial statement may be misstatement. misstated. For example, there may be a need to perform other audit procedures, or procedures may arise for where management is unable to provide an explanation, or the explanation given is contradicted by other information gained during the course of the audit. And therefore, the auditor needs to apply professional skepticism in evaluating whether or not additional procedures, analytical procedures, need to be performed to see whether or not any further evidence can be ascertained as to the overall conclusion of the financial statements, whether or not they fairly present or not, and whether or not this is consistent with the auditor's understanding of the entity. With regard to the other information, so we touched on that with regard to the requirements of the Companies Act. Other information, no requirement to audit that information, but the auditor's report should identify which other information was available at the time of the audit and which would be available subsequently. This may be, for example, sustainability reports which hadn't necessarily been published when the financial statements were being issued. And from a 720 perspective, the auditor is required to read that other information to make sure that it is consistent with the auditor's understanding of the financial statements. Where there are contradictions and further procedures may need to be carried out to establish whether or not the financial statements are materially misstated. If there is no misstatement in the financial statements, so then obviously an unqualified audit report could be issued, but the auditor would be required to report those inconsistencies to make sure that management correct them, or there may need to be another information paragraph whereby that is addressed. For example, the director's report or the detailed income statement may have information included there which doesn't correlate with the auditor's understanding of the entity based on the procedures and discussions and evidence that they have obtained throughout the audit. Very importantly, the code has been changed. There's a new code of professional conduct, and the biggest change therein has been the focus on professional skepticism. And when it comes to professional skepticism, the auditor needs to make sure that they exercise professional skepticism by means of an attitude that includes a questioning mind, being alert to conditions or circumstances that may indicate possible misstatements due to error or fraud, and they need to critically assess information that it may be misstated. Here I have identified that the lack of professional skepticism demonstrated when the engagement team assists with disclosure in complex matters, complex accounting matters, is significantly decreased, and therefore one needs to make sure, first of all, that one is operating on the correct side of the ethical code, and secondly, that one is alert to areas in which professional skepticism needs to be applied, because professional judgment, there needs to be an understanding of how professional judgment, what information has been incorporated, what information has been discounted, the process that has been followed for the auditor to arrive at their explanation, at their what they have given weight to, the evidence that they've relied on. So very importantly, what work the auditor has done, why they focused on that, what they've given preference to, where the information has been obtained, where the auditor was able to evaluate that, the processes and assumptions that were relied on, that were audited and understood, from who that information was obtained. Is that a third party? If it's not a third party, can it be corroborated if it's internal? When was the information supplied? Was it timeous? Is there any additional information that's required? Why is this information being utilized? Is there any other information? And then ultimately, the procedures that have been carried out, is this consistent with the auditor's understanding of the necessary requirements? I don't know if there's any further questions, but the final slide is that when it comes to the audit of information, particularly disclosures, if it hasn't been documented, the regulator considers that the procedures have not been carried out, and therefore there would not be support in the financial statements for that. The documentation needs to be sufficiently detailed to describe the nature, what procedure was done, the timing when it was carried out, and the extent of the procedures. What was examined, sample sizes, making sure that the population was adequate and complete. And it needs to be done in sufficient detail to allow a third party to be able to reperform the procedure and ultimately arrive at the same conclusion. That's all for today, a slightly shorter session, but if you have any questions, I'll stay online for a bit, and please do feel free to ask your questions if you haven't already. Great, thanks. Wishing you all the best. Stay safe and stay healthy.